Good afternoon, everybody. It's David Perlmutter from Quantum Listing. Thank you for joining us today on our webinar, Loan Workouts and Approaching Lenders for Debt Relief with Aron Youngerwood from Lucrum Realty. Thanks so much for being our guest presenter today, Aron. Before I hand it over to you, I am going to let those watching now and in the future know a little bit more about you. So Aron is a founder of Lucrum Realty, a national real estate and debt advisory platform focused on representing borrowers and owners who need assistance with their loans, including representing them with lenders and CMBS servicers to request debt relief, loan modifications, and restructurings, and to come up with business plans for working out their assets and bringing in rescue capital. As an executive at CBRE Global Investors for over 10 years, he has deep relationships within the real estate industry, including with lenders, servicers, investors, and operators, and has completed transactions totaling more than $10 billion across the apartment, industrial, office, hospitality, retail, and mixed-use asset classes nationwide. As part of his role at CBRE, he led their team's loan restructuring efforts during the last recession, with over $5 billion of debt restructured, as well as over the years where he has worked with lenders and CMBS servicers to successfully modify client loans or recapitalize client assets across different loan types and across the asset class spectrum. Whether CMBS, agency, bank loans, debt funds for life insurance companies, modifications included forbearances, maturity extensions, loan principal reductions, interest rate and amortization relief, changes to collateral, discounted payoffs, deeds in lieu, release of guarantor liability, and loan assumptions. So for those of you watching, rest assured that you are in very, very good hands today with Aron. And I am personally looking forward to a good education. Fortunately for me, in my years as a developer, I never had to engage Aron and his services. But you know, we are living in difficult times now, and without any doubt, there is going to be a huge demand for loan workouts, as I'm sure there already is, and lenders and owners are having these conversations every day, and the more tactics you have when you make that approach, the better off you and your investors are going to be. So welcome, Aron, and thanks for being with us today. Sorry.
Thank you, David. Do I have control of the presentation, or are you doing the slide?
You can either one. You can take control, or you can just ask me to push it along, whatever you prefer.
You know, I'll let me take control just to make it a little easier. If that's okay with you, David. I'm going to share my screen. Bear with me, everyone.
Looks like you're.
You know what, David? Why don't you control? Because I've lost it. Actually, no, I've got the presentation here now.
Okay.
Okay. Can you all see?
Yes, we can. Thank you.
Great. Well, hello, everyone. Nice to meet everyone. Fortunately, I wish it was in person rather than by webinar. I like to make this as interactive as possible. Really, the purpose of this is to be helpful and practical to each of you. I realize, based on looking at the list, each of you are coming from different perspectives. Some of you are brokers, some of you are attorneys, many of you are real estate owners. You obviously have others are advising real estate owners and operators in different capacity. Nevertheless, irrespective of your role, there's a significant part for each of you to play to the extent you or your clients need help with their loan, which it sounds very, very general. And I think this presentation is even helpful, even those who are fortunate enough to be owning real estate that isn't suffering any hardship. Because understanding, what can happen and being prepared is the most important thing to be aware of. So even if you've got a well-performing property, a well-performing loan, just understanding the process will be helpful, such that if things spiral out of control over the coming 12 months, and hopefully it won't, you'll be prepared in how to approach your lenders should you need any type of relief. So I prepared some very, very high-level slides, and I'm going to keep it high level, and I welcome any questions. And David, what I suggest we do is maybe after each 1 or 2 slides, we can break for questions or at a natural, or have a natural pause.
Sounds great.
Okay, so I just lifted the CMBS delinquency rates. Now I realize for many of them, most folks have loans with different types of lenders, and I'll go through that separately. But using CMBS securitized loans as a litmus test in terms of how different asset classes are doing, you can see the list here. By far in June, and you can see the numbers in May, the hotel delinquencies within CMBS have really rocketed from 2% in May to 11.5% in June. These are just recent publications. Retail is the second, 7.86%, and then the other asset classes you'll see are very distant third, fourth, and fifth. So clearly hotels have been most affected by COVID, retail has been most affected by COVID. I'm not telling you anything new. And clearly the lenders are very attuned to that. So what lenders are doing now, whether you are balance sheet lenders, retail banks, Fannie, Freddie, or CMBS, they're triaging any types of loan requests. What I mean by that is if you're coming into a lender and asking for relief, they're going to look at what type of asset it is. If it's hotel, if it's retail, they're going to understand what's happening. They're going to understand what's going on. And you need less of a story to explain the fact that your hotel is at minimum capacity. Conversely, if you have another asset class such as office, industrial, multifamily, which have been less affected by COVID, you'll still get the lender's attention. You'll just have to explain what's happened. If you're in a state like most states out there that has a moratorium on evictions, you'll be able to explain that your tenants unfortunately aren't paying rent, rightly or wrongly, and therefore you need some type of relief. I'm going to switch to the next slide. So when you're looking at your asset and you're looking for your needs over the next 12 months, and hopefully some of you will come up with a budget for the rest of the year for your assets or your work with your clients, so you can understand where you may be short over the coming months. Understanding who the key players are. Now I realize this is obvious to most of all, but obviously the first is your client or you as the borrower owner. To the extent you're going to the lender for relief, understanding who at the lender is really making the decisions. And candidly, of all the loan workouts I'm doing for my clients, understanding who the decision maker is probably the most important and candidly the hardest and most time-consuming aspect of getting a loan relief. It's one thing to know that Bank of America or Midlands or Rialto or is the lender, but getting through to the right person and getting their attention is very, very hard. And just for those who have CMBS loans, for example, trying to get in front of special service, it can often take months. So I have a client, for example, who came to me last week. He's been waiting for 2 months to get in front of their special servicer. Look, and we understand special servicers are all backed up. They are dealing with fire drills. They are dealing with more priority loans, such as the hotel, the retail loans. So getting in front of the right decision maker in a timely fashion is critical, especially as time is of the essence. And then thirdly, if you have a hotel assets, to the extent you're getting or seeking type of loan relief, you need to understand who else you need to get approval from. And if you have a flag and a manager, whether it's a Hyatt, Marriott, etc., or Choice hotels, you obviously need to think about them and what decisions and consents they need to approve. I'm going to move to the next slide. Before we take a pause, understanding who your lender is an obvious question, but each lender is agreeing to different types of relief. So the fact that your friend down the road got a principal and interest 90-day forbearance from the local regional bank doesn't mean you're going to get it from a private equity lender, a bridge lender, or CMBS. Each of these lenders have very, very different rules of the road, and they have very different types of ownership they have to answer to. So look, we all know with private equity or regional, there could be a relationship. The lenders could be your golf buddies. They could be friends from the local church or the local temple, where you can get hold of them on their cell phone over the weekend. And if you need some type of relief, forbearance, etc., you can get it done pretty quickly, pretty efficiently, and pretty cost effectively. I know from my experience, we're getting relief from regional banks with no questions asked within 30 days. Conversely, with private equity lenders and CMBS lenders, it's a very, very different story. CMBS lenders have to answer to their bondholders, their shareholders. You have no relationship with them. They aren't your golf buddies. They are really looking out for their own bondholders, their own shareholders. And so getting relief from them is a very more challenging environment, and understanding the rules of the road and how they operate is critical. Should I pause there, David, before I talk about what I'm seeing and kinds of relief?
Yeah, I had a couple of questions, and hopefully some of our guests will also. So the delinquency that you're referring to, is that complete non-payment, or is it partial payments, or some combination of the two?
Yeah, that's a good question. So it's anything from late payment to non-payment. So the way in the CMBS world, if you're 30 days late, you haven't made full payment, you'll be put on a watch list. Then after, depending on the servicer, 60 or 90 days, then you get moved to special servicing. So it could mean someone hasn't paid the full amount of loan, someone hasn't put the full amount in escrow, so it varies.
Got it. Okay. And CMBS, for those who aren't as familiar with that, is commercial mortgage-backed securities, correct?
That's correct.
So that's.
I can explain that. I can explain the concept and what CMBS is, if that's helpful to the audience.
Probably, I think people have all sorts of different levels on the learning curve, so I think it would be good.
Yeah, so many folks, especially probably hotels, retail, multifamily, which compose a large amount of the CMBS pool, when you buy an asset and you go for your broker to get various loan quotes, many people like CMBS for a number of reasons. Firstly, you get high leverage. It's non-recourse. So unlike the loans you get from the regional bank, you're not signing any types of recourse, and you get very, very attractive rates. So CMBS has been a very, very popular loan class for a lot of people. Conversely, the challenge with CMBS is it's not relationship lending. So under a CMBS loan, there are effectively three groups of people who are kind of pulling the strings. There's someone called the master servicer. And so for folks who have a CMBS loan, that will be the group who you're paying the loans to and who are sending the debt statements every month. It could be a Midlands, it could be a Wells Fargo, it could be a Rialto, etc. Then, if you need relief, you can either request it from the master servicer, who is empowered to give you certain very minimum types of relief. But if you're trying to get more comprehensive relief, for example, a deferral of interest and payments, or amortization relief, or a discounted payoff, then you really need to get what's called transfer to a special servicer. And a special servicer is appointed by the bondholders of the CMBS pool to really help review the loan file, entertain any loan workout requests, and then make a recommendation and bring the file to the bondholders. And then the third, in case it's not obvious, are the owners of the CMBS loans. So similar to a regional bank, where if it's a balance sheet loan, the bank will effectively be the owner. With CMBS, the loan is effectively owned by different series of owners and borrowers with approval. So you have the life insurance companies down to private equity funds who own different tranches or different levels of the CMBS loan. And depending on where your loan is, each of them or some of them need to approve the consent. Usually it's someone called the controlling class representative who owns the bottom part of the CMBS loan, who will be most affected by the request you're getting.
Great, thanks.
A lot of information.
Yeah, so that was very helpful. Thank you so much.
And so clearly, if you have a loan with a regional bank or a private equity fund, you can usually get in front of the right person fairly easily, and they can make decisions fairly quickly. It may not be the decision you want, but you can usually get through to someone. With Fannie, Freddie, with CMBS, it's much more difficult. So the process with CMBS is the master servicer can agree to certain limited rights. They can waive a late payment charge. They may allow you, depending on who they are, to use certain reserves you have. So for example, if you're struggling to make debt service and you have $100,000 for CapEx or interest escrow, then some master servicers will be empowered to release that and let you use that to pay debt service. Now, let's be clear, it's not going to be forgiven, it's going to be deferred. You're still going to have to make it up. Otherwise, if you're looking for more comprehensive relief, then you need to either go to the special servicer via something called a performing loan consent or a transfer to special servicer. And the difference between performing loan consent and transfer is really the amount of relief you're getting, the amount of fees you're going to be charged, because special servicers do charge fees, and how quickly you're going to get the relief. So if you want to use, for example, reserves, you want to waiver certain breaches, you want to have a suspension of cash management if you have a cash trap in your account, then most special servicers will allow you to do what's called a performing loan consent, which means within 4 to 6 weeks, you can get approval if they indeed approve it, and you'll pay fees of anywhere from $10,000 to $20,000 plus legal fees. Conversely, if you need more comprehensive relief, such as deferral of principal and interest, or amortization relief, or discounted payoffs, you're going to have to get a full workout, and that's something called a transfer to special servicer. And on the one hand, that's good because the special servicer is empowered to review your file and give you more relief. On the other hand, the fees are much, much higher, but obviously negotiable. Should I pause there for any questions, David, before I continue?
I think you can keep going. And if anybody can hear the rain on my skylights or roof, let me know and I'll mute myself in between questions.
One thing we all need to be mindful of is we obviously don't want to lose our assets. So once you get in front of a lender or a servicer, you're always going to have a risk that they're going to look at your file. And the last thing you want is to give a lender a reason to take over your asset, appointing a receiver or going through a foreclosure or making a claim against you. So one advice that's really, really important for each of you and your clients is before you approach a lender, make sure you know what you want and what relief you want. Also, make sure if you breach the loan documents and breach the guarantee provisions, you understand your liability and exposure and cure it. The last thing any of us want is to go to a lender and they turn around and said, you know what, you've tripped your guarantees. You, for example, approved a lease without our approval. You haven't paid your insurance premiums. You took security deposits to pay operating expenses. Those are no-nos. And the reason I'm flagging that is I've had clients who have tripped their guarantees and the servicer gets aware of that and basically can go after the guarantors personally. That's the last thing you want. So be smart before you approach a lender, understand where the skeletons are and try and cure or fix to the best of your ability any violations or breaches other than obviously payments. I've included a few obvious do's and don'ts. Some of it, again, I apologize, is obvious, but having worked with a number of borrowers and owners the last few months, I still see some of the don'ts, and I encourage my owners and clients to do the do's. So my advice to you is be early. The best position you want to be in if you're approaching a lender for some type of relief is to be current on your loan. the number of times I hear from the special services and the lenders I deal with on a daily basis is, if you come late and you've already missed much of payments, you're going to have a much harder time. And conversely, the lenders can have much more leverage over you, which is not a position you want to be in. So I encourage each of you, look, even if you're current now, do a budget for the coming year. Assume this COVID could be around for a while, unfortunately, or could come back. And can you manage through it? And if you feel that in 3 months' time, based on your budget, based on your forecast, you're not going to make loan payments, I would encourage you to reach out to your lender now, early on, before you need them. Secondly, when you approach your lender, they want to know you have skin in the game. So if they see you're transparent, if they see you're focused on the property and you've got a clear operational capacity, hey, I have a team of 5 property managers working full-time. Even though we've closed the leasing office, we have a 12-hour telephone line for tenants. We've been sensible in the way we've managed the property. We've deferred CapEx and various other payments so we can make sure we pay. You want to demonstrate your commitment. You want to show to the lender you're aligned, and that's a good reason for them to say, you know what, we're going to give this borrower relief because they're going to work with us. That's critical. The other 4th and 5th point is come up with a plan, and this is what I help borrowers with. Understanding your future operations. What I do with our servicer that I work with is I do a pro forma for the coming 12 months. I show the weaknesses and I show our plans to deal with the shortfalls as best we can. And then lastly, especially with CMBS and certain lenders now, you want to show your skin in the game. The lender's perspective is if you're coming to them, they're going to say, well, why should we be the ones hurting? We're the lender. We're not the equity owners. You're the equity owner. You should be putting money in, not us. So we want to see you're putting money where your mouth is. So if you're coming to us and we find out that a year ago you just refinanced your loan with us and took out a few $1 million, we're going to be less sympathetic. We're going to want you to put that money back. Conversely, if we see that the last 6 months before you came to us, you've been taking equity contributions, we're going to want you to put that money back before we're going to give you any type of relief. So it's not a no-no, you just want to understand the lender's mindset. So if you're someone who can come in, you can show, look, we haven't taken distributions the last 12 to 24 months. We're willing to support operations on the property. We're willing to put our own money in or get a PPP loan and put money in. You're going to really, really help yourself and really encourage the lender to give you relief. And that's why coming in early, coming in with some muscle will really help your position and maximize your chances of getting loan relief.
And right now, the government hasn't stepped up with any specific programs geared towards, helping with the workouts at all. It's still, everything's in private hands, correct?
Well, they have, with CMBS, the government haven't, it's a little nuanced. They haven't given a bailout of CMBS. Clearly, Fannie and Freddie are telling borrowers they're going to agree to 90-day forbearances or PNI, and the regional banks have followed. But the private equity and bridge lenders and the CMBS aren't following the same pattern. They're willing to entertain it, but they don't have the same requirements as the Fannie and Freddie and the regional banks.
Great.
Let me go through the don'ts, kind of converse to the do's. The stop paying debt service prematurely and non-engaging. If you do that, it's not going to put you in the best position with the lender, unfortunately. Secondly, making unrealistic requests. A lot of my clients come to me and say, you know what, I'm going to ask for 12 months amortization relief and a reduction of my principal from 25 to 23 million. And I'm also going to ask for 180-day P&I forbearance and a release from defeasance because I want to sell in 2 years' time. And even if the lender only gives me one of that, I'm fine. Unfortunately, if you're on CMBS, that's not the right approach. If they perceive you as making unrealistic requests that they're not going to give you, they're going to treat you much less lightly. They're going to want you to really think about what you really need and make a case for it. And if you narrow and tailor your requests, you'll generally be in a better position than if you make a whole menu of requests in the hopes you'll get one or two. Similarly, look, it's a stressful situation we're all in. I've been there. I was with CBRE dealing with their loan workouts during the last recession. You don't want to be making empty legal threats. Often dealing with special services can be emotional. You're going to get frustrated with them. They're going to say no a lot. And it's very normal for people to say, you're in violation, I'm going to get my lawyer to sue you. Or even though that may be your instinct, all that happens when you do that is the lender and the servicer shuts up and the path goes through the lawyers. And that's not what you want. You want to keep your relationship and your request at a business level and not through the lawyers. The lawyers will also be critical when it comes to working out the loan documents and finalizing details, but my recommendation is not an early stage. And then the last and really most important is really make sure you haven't breached your guarantee covenants, your guarantor requirements. I've had a few situations where, in one case, a retail client came to me. They had allowed a tenant to leave early. They had replaced a property manager, all without lender's consent, and that created a personal liability for them. Really, really be thoughtful of that. Can't stress that enough, because I still see quite a lot of that. So that's kind of my slides. I can go through some stories. I can go through what I'm seeing on a practical level, but happy to open up for questions.
I'd say if you had to compare the level of delinquency, I mean, we saw that in the initial slide, but where it's getting to like the more critical stages, now compared to under pre-COVID times, and what what multiple are you seeing on issues that are coming up now?
So I want to make sure I'm answering your question. So clearly the borrowers and owners who are having the most trouble are the hotels and retails. Those who had to close down completely really can't make any debt service, and so they're completely delinquent. Conversely, the office, industrial, multifamily haven't had to close down. So those clients of mine in the multifamily space, they may be struggling to make ends meet because tenants aren't paying rent and they can't evict tenants, but generally they're having less distress than a hotel and retail. So they may be making partial payments or late payments rather than non-payments. Obviously, each case is different, so I don't want to generalize, but that's the themes I'm seeing. To answer your question, David?
Yeah, I think so. Is Jeremy Glantz still with us there? Jeremy, I know you've got a question. You always have a good question, Jeremy. Jeremy is a friend of mine who's in the title business. So he, in part of your, the dance that you're doing with your clients and the lenders, are you seeing involvement with the title professionals?
So am I seeing involvement with the title professionals?
Yeah. Or
yeah, not at the workout stage. Obviously, title agencies play a critical role if there's any change on the collateral, for example. So where I've seen title can be very, very helpful is a few cases where clients want to get collateral release. So for example, they have a CMBS loan with 3 assets, and they want the lender's consent to sell the underperforming assets and keep the remaining 2 assets. And often lenders will be amenable to that, depending on the particular situation. Obviously, getting title involved will be critical given the release of the collateral.
Got it. Interesting. And
I'm sure there are other situations I'm not thinking of now.
Yeah. And do the lenders ever, if they see somebody who's making an earnest effort to do everything they can to stay current and to maintain their property, do the lenders in those circumstances ever say, you know what, you're doing great with X, Y, and Z, but your marketing could really use, a little boost? Are they being helpful, or are they really just kind of rubbing their hands waiting to get back the assets so that they can have their way with it?
I think it's a mixture. So With the regional banks and some of the private lenders where the relationship's important, they'll probably want to work with you. If they see you as a valuable relationship, it's going to give them business. Clearly, it's in their interest to work well with you, and so they'll be more interested in relief, especially if you're, playing well with them. On the flip side, CMBS lenders are playing hardball. They will be more interested in giving relief if they think it's in their bondholders' interest to work with you, but they'll have no compunction in taking back the property. Again, their interest is to maximize returns of their bondholders. And if they see that despite your best efforts, you have nothing to bring to the table and your property is unlikely to improve, they'll have no problem putting a servicer in place, unfortunately, and holding on to the assets and then ultimately selling either the note or foreclosing on the assets. Again, the special servicer is answerable to the bondholders. They don't make the decision, they make a recommendation, they'll bring a package. But the bondholders, who are often private equity funds and hedge funds, may be very interested in getting at the assets. So you need to understand the interests of the lender you're dealing with. If it's a CMBS loan, understanding who the individual groups are and what the motivations are.
Yeah, you have to be a psychologist in addition to everything else, it sounds like.
Yeah, but looking at the last recession, I know there are a lot of people out there looking for distressed deals, and there are brokers out there who are probably seeing more than me in terms of what's out there. But I can tell you, in the last recession, when things really turned ugly in 2008, it took probably 2 or 3 years before distressed deals came in the market, before lenders were selling notes or selling the properties. So if you use that as an example, I wouldn't expect lenders to immediately start putting things on the market now, or making note sales. And only semi-positive spin, if you can say that, about COVID is in states that require judicial foreclosures as opposed to non-judicial foreclosures. It's obviously going to be very hard if a lender does want to take over asset, getting a judicial foreclosure given the courts are closed or heavily backed up. So if you're in a state that only allows judicial foreclosure and appointments of receiver via court order, that probably play well for you, because you can then have the time to work out the loan with the lender, knowing they'll have a hard time going to court.
Interesting. And are you seeing the lenders behaving differently, in the global pandemic than they did, in the recession? Are they being kinder and gentler, or are they just,
They're certainly being a little more understanding, absolutely. And even though they're not required to offer 90-day forbearances and the like, they understand that, they understand the situation. Look, they still got to keep their bondholders happy. And some of the bondholders, the reason they went into CMBS and is, in these situations, and they own the most risky tranche of the CMBS loan, is to get their hands on the properties. So clearly, if you come to them and the reason you're coming for relief is because of COVID, you're going to get a sympathetic ear. If it comes to them because your property wasn't performing even before COVID, you'll probably get a less sympathetic ear. So for example, I have a few clients who are in cash trap and they want to get the lender to release the cash amount so they can pay debt service. And what the special services are saying is, if you're in cash trap before COVID, then we're not going to release it. That's our security. We're not going to release it without, a fundamentally good reason. If you're in cash trap because you failed the debt service coverage ratio test because of COVID, then we'll be much more amenable to allowing you to take the money from the cash trap and paying for debt service.
So I would love to hear, and I'm sure the sentiment is echoed by everybody else, some of those war stories about that you alluded to a moment ago.
So look, there are, and hopefully no one's in this situation. I've had a few groups who own hotels and retail centers who have just completely shut down. There was one hotel client in Hawaii that was completely shut down, another actually retail mall in Hawaii that was completely shut down. And even before COVID, the value of the property was about half the value of the principal. Now, to most of us, you'd think why are you bothering getting loan consent? You might as well just hand the keys back. And that probably makes a lot of economic sense given the situation. The problem with these clients, and for many borrowers out there who want to give back the keys because they can't save the property and it's so underwater, is given the tax rules, you can get hit with a huge tax liability for the loan forgiveness. What I mean by that is, if the lender, if you have, say, $100 million loan, and the value of the property is $50 million, the lender's effectively, when you give back the keys, the lender's effectively reducing your loan and forgiving $15 million. And under the tax rules, and I'm not an accountant, but under the tax rules, that's treated as loan forgiveness and as income, ordinary income, I believe. And so I've had a number of clients who are desperately trying to work with very, very difficult special services, particularly in this case, two in Hawaii, where the special service is not playing ball. They put a servicer in place, and we're trying to come up with a restructure that will minimize the tax liability that this borrower is going to have to pay, even though they want to give the keys back. And it's taken about a year to get, unfortunately, to get the special services attention, to even work, to even entertain an offer from the borrower. So this is not an easy situation. This is really a truly horrendous war story that I hope none of us are in. And understanding that CMBS lenders aren't always going to play nice with you.
Yeah, I think, and you probably young to have been in the business at that point, but during the late 80s, it was a savings and loan crisis. Prior to that, the crisis, there was a change. One of the things that precipitated the crisis was a change in the tax law. And all these shopping centers that you drive by that have no frontage to the street and should never have been built were often built like in the 70s and 80s through syndications where people built things that didn't make economic sense because you could take the passive losses you were getting on your investments and offset income from either your work or other investments. And then when that law changed and you couldn't take those, people started handing the keys back to their lenders left and right. And I had one friend who was in half a dozen of those deals, and he didn't want to end up getting the huge tax hit that you were talking about by by handing the keys back. And so he ended up raising money and buying those shopping centers that he had invested in and ran them, and made a viable business out of that. Do you see, if you could look into your crystal ball, do you think we're going to see things like that in the next several years?
You mean people bringing in rescue capital?
Yeah, and sort of taking things back from the syndicators or from the promoters of these deals, just so that they can take control of it instead of having somebody else having their fate in somebody else's hands.
Yes, if I understood, if you're talking about kind of rescue capital, absolutely. So I've had a few CEOs of regional banks tell me very clearly, look, we've given borrowers 90 days of principal and interest back in April. If they come back to us now in June, July, it's July now, and want more money from us, I'm going to tell them very clearly, we've done our bit. You need to bring in a third-party equity investor to recapitalize your asset and split equity in before I'll even consider giving you any type of relief. And I think that's, to the extent you can bring in rescue capital, and I understand it's not for everyone. What I mean by that is someone who can inject equity to help stabilize your asset, and usually, depending on who they are, they'll require a preferred return, or they may require some level of control of the property. That can be certainly very, very helpful in terms of getting lender approval. Because again, they're the lender, you're the equity. They're gonna expect you to unfortunately bleed before they are willing to give you relief. And so if you can't put your own money in, bringing in additional equity is gonna be very critical, and I see a whole new market for that.
Are you seeing a lot of vulture funds, beginning to form, waiting on the sidelines, licking their chops, waiting?
Oh, yeah. There are a lot of distressed funds out there from some of the big names waiting to kind of pounce. I think Brookfield have raised, for example, a distressed retail fund. I know even some of the bridge lenders have affiliated vehicles that are really there to snap up the assets. It's kind of, it sounds like a conflict, but there are a number of private bridge lenders I know who are very interested in taking back, for example, industrial or multifamily, you know, sexy asset classes, and then having their affiliates or affiliated funds buy the property. Now, if it's CMBS, there are various rules and regulations. You know, you can't just get a huge discount. There are various rules to make sure you're buying at a fair value and there's a proper process. But unfortunately, that's going on. In the 2008 crisis, a lot of the one or two special services who owned auction houses. And so what they did was they took back a property, they put it on their auction website and got a nice commission for selling the assets. That's stopped now, given the conflicts, but there are various conflicts still going on.
Yeah. We have a question from David Stewart. By the way, it's not really me. My middle name is Stewart. I'm David Stewart, but this is a third party David Stewart. Hello, David. What should be the priority of the rescue capital, especially vis-a-vis any other loans, including mezz, on the property?
So say the question again, please, David.
Where should rescue capital fall in the pecking order of, if there's mezzanine loans on the property or any other, second loans, where does the rescue capital fit in the pecking order there?
So generally equity will always be subordinated to the loans. So when you bring in rescue capital, usually one, helping to stabilize the asset, but you're also using that in a way to motivate the lender to grant you relief. So generally lenders, both senior and mezz, will want the rescue capital to be subordinated to them. Now you may be able to cut a deal with a mezz differently, but I think that'll be more the exception rather than the rule. Now, one thing I'm seeing is AB note restructures. And for those who aren't familiar, what that is if you have, what it does is it basically divides the loan. So let's say you have a $100 million loan and you can only pay and afford debt service on, say, a $50 million loan. And the property's worth $50 million. Let's keep the math real simple. What an AB note restructure does is it says to the lender, look, I'm going to default. There's no hope. But if we come up with an AB restructure where we are dividing the loan into two classes, an A note class and a B note class. The A note class will be a $50 million loan that will be senior. And the B note class will be a subordinated loan that will be subordinated and only paid back if there's enough equity. And so if I bring in rescue capital lender, I'll make sure that the $50 million A note, that's senior, will be paid back. But once it's paid back, then the additional equity I put in needs to get paid back plus a preferred return. And only then, if there's enough money, will we pay back the B notes, the remaining 50 million. So in that situation, you've kind of made yourself semi-senior to the senior lender via the AB note restructure. And the reason that can work is it also helps the lender, because you're basically, if the lender's going to have to take a cut of half the loan, but with the AB structure, there's a hope note where not only will you be able to pay 50 million, but you can also pay the remaining piece. And to do that, you need to get equity capital. That could be a win-win situation for both the lender and the borrower.
Okay. Are lenders at all willing to convert some of their debt to equity, or has that become a conflict of interest?
I haven't seen that. It's a good question. For private lenders, yes, that's something that's negotiable. With CMBS, with Fannie, with Freddie, certainly not. But with private lenders, yes, that's certainly negotiable. I haven't seen much of that right now, but others in this group may have.
Interesting. Thanks, David, for your question, and hopefully I interpreted it correctly, and so you got the answer that you were looking for. We'd love to have some more questions.
Hey, David?
Yes. Hi, Dan. How are you?
Daniel, yeah, may I ask some question?
Yes, please.
Hey, yeah, Aaron. Hey, thank you so much for your great presentation. Yeah, I explained a lot. I'm a commercial realtor, and then actually, yeah, I have some clients who wants to purchase some property that such kind of distressed property, which they may be able to get either buy some discount notes or purchase the property directly. Yeah, no matter from the special servicer or from the owner directly. Right now, I have a scenario, and then after that kind of scenario, I want to ask you some question. Maybe I'm not sure whether you can give me more deals like this. The scenario right now, I'm helping one client that he's the anchor tenant of a shopping center, and like shopping center, previous owner purchased at about 4 million, and after that, he cut two out parcels and then sold those two out parcels, right? And then I believe that that's already worth more than 2 million, 4 millions. And after that, he did a refinance of 6.5 million. And then based on that, basically, yeah, the 6.5 million basically is the money that the previous owner already got. But right now, seems that yeah, the loan is under the hand of the special servicer, and my client wants to is checking whether he's able to purchase this kind of note from the special servicer. I want to see for this kind of scenario, right now he's still paying the rent to the special servicer. So do you know if the loan is in the hand of the special servicer? Usually, is that paying should the tenant paying the special servicer or still paying the owner of the building?
Yeah, so so nice to meet you. If I make sure I understand the question, so if it's a CMBS loan, payments always go to the master servicer. The special servicer is only there to entertain a workout or a loan relief request. So payments should still go to the master unless the special tells you otherwise. Was that your question?
Yeah, based on my understanding, usually if the loan has been transferred to the special servicer, then usually the tenant need to pay the rent to the special servicer instead of the owner. Is that right or that's not true?
So, well, firstly, you should always take direction from what the lender says, but generally the master servicer collects the rent payments.
Okay.
And the special servicer is really the one who works out and deals with the loan. Because what happens is once you've finished, if you obtain the relief you've requested, the special servicer will then transfer your client's file back to the master servicer.
Okay. Okay. So, I mean, in such a case, do you think that yeah, my client has some chance to get a discount from the loan balance to purchase this note?
So what's your question? How can the owner buy back?
He'd be able to buy back his note from the at a discount.
Yes. So that, yeah, I mean, that's something certainly you can entertain. It's obviously hard to do when you're the owner, but yes, you know, I've obtained, for example, discounted payoffs or discounted loan notes from the lender. I mean, often what lenders want to do, especially the CMBS, is they'll want to make sure they're getting the best value. And the only way they'll know they'll get the best value is if they put it on the market via a third-party brokerage firm. Also, the concerns with the lenders have, special services have, with allowing the owner to buy back the note is their own fiduciary obligations. Given, you know, if they gave it back, let's say your client has a $20 million loan and they want to buy it back for 15 million or do a discounted payoff of 15 million, the lender will want to make sure if it's a loan sale that they're getting the best value. And the only way they can do that is by going to a third-party brokerage firm. So if I call my friends at Special Servicer and say, look, I'm really interested in buying discounted notes, will you sell them to me? They're going to say no, even if they wanted to, because they have to protect their own interests, and they're generally just putting notes on the market with brokers, unfortunately. So I think it'll be a hard request to make, Daniel. If it's CMBS, if it's a private lender, then it's a different story.
During the Great Recession, I had a friend who owned a building in one of the neighboring towns, and he had Borders books as his tenant, and Borders, went out of business, and he wanted to buy back the loan from the bank at a discounted rate. The bank told him, "Sorry, we're not going to do that," and they ended up selling the building, a year or two later for less than he would have given them, at the time for the discounted note. So I think, what you're saying about the fiduciary responsibility is really on point, even if, in the long term run, it ends up hurting the, the investors in the notes. I think that you have to make sure that you're not doing anything. At least they were putting themselves in the position to do the right thing for their investors. You can't control the outcome necessarily, though.
So when will the foreclosure start? I mean, the special right now, seems that the original owner is still negotiating with the special servicer. I believe that they want to get some discount. So when usually will the foreclosure start? If they cannot reach some deals, then it will go to the market, or what's the procedure for that?
When two things can happen. So if the lender's taking back the property and foreclosing, then they'll put the property on the market with a broker, and then your client can bid on the property just like everyone else. It's, marketed deal. If the lender decides to foreclose and just holds on to the property and not sells it, some lenders have done that. Then obviously you can continue negotiating with them, or bring in a third party to buy the assets. But generally, if you're affiliated, the lender's not going to want to sell the property or a loan, especially for a discount, to someone who's affiliated with the borrower owner. And indeed, will make you sign any buyer of that loan or property will have to certify that they're not affiliated in any way with the borrower owner.
Okay, so because my client is the anchor tenant of this building, and right now almost all other units are vacant, and he is signing the lease month by month. So in such a case, I think my client should have a bigger power to negotiate with the
Absolutely.
lender.
Yeah, in that situation, they certainly have a lot of power. I don't disagree. I'm just, again, if it's CMBS, I'm just telling you what they can and can't agree to, even though it makes sense. But clearly, your client's going to in a very strong position of leverage, and strong position really to help prevent getting foreclosed upon, given that, because the lender lender's really interest is to make sure if they do sell the note or they do sell the property, that they maximize the returns. And if they're not going to play ball with the tenant, and the tenant could just leave or stop paying, clearly that's not going to be helpful to them.
I see. Okay. So I have several other clients. Yeah, definitely they are sophisticated clients, and they are looking to purchase some discount notes. I'm not sure whether you have this kind of service or you have this kind of notes that you work as a broker, can sell this kind of notes or deals that maybe I can get your contact, and then I can reach out to see some deals that my client can purchase from you.
Yeah, I'm not a broker, although I'm not a broker. Certainly, many of the notes on sale now, and not that many, are going through the main brokerage houses. The CMBS, the GLL, Cushman, all have groups that specialize in note sales. What I am seeing is on the private bridge lenders, I do see low note sales that come to me because of my relationships. But again, I'm not a broker. My clients and my investors have rescue capital, and they can bring in. But certainly happy to talk to you after the webinar or another day about deals I'm seeing. If that's helpful.
Okay.
Thanks.
Okay.
Daniel.
Thank you. Thank you.
Anybody else have any questions for Aron? Don't be shy. It's a good opportunity to get all those questions answered.
And David, feel free to share my contact information.
Yes.
If folks want to reach out.
Julia, is it on one of the slides, or can you put it in the chat, Julia? No. Hang on a second. We definitely have your contact information. It's
Don't worry.
on your slide, it says. Okay, so, oh, hold on, I'm gonna take back the control because I may have a slightly modified version, hang on. And, okay, so here we go. There we go. So if you would like to contact Aron, and we certainly hope you will, because I think he's earned all of our trust today, you can reach him by telephone at 310-785-9491 or at ARONY at lucrumrealty.com. And Lucrum is LUCRUM and realty.com.
And our contact information, David, thank you, is on our website.
Okay. And you can also go visit and learn more about Lucrum Realty at lucrumrealty.com. To boot. So, oh, wait, hold on. I see there's more. There might be more in the chat. Let's see. Okay. Julia will kindly put the information in the chat as well if you would like to just copy and paste it from there as well. And we're going to be sending around the replay, and you'll have access to Aron's contact information via that as well. But no, this was really great, and it's certainly information that the commercial real estate market needs to have now. There's. Do you see? Obviously, nobody knows how long the COVID crisis is going to last. But say it ended in January 1. How long do you think we're going to be feeling the ripple effect from that?
If COVID ended, hopefully it will.
Yes.
January 1, what was your question, David?
How long are we going to be seeing the ripple effects from? Sorry, I'm looking for. I don't. The ripple effects from COVID. How long do you think it's going to take for the real estate market to absorb all these shocks? Saying, knowing if there was like a finite amount of damage, based going to the end of the year.
Gosh, I can't hope to respond to that. Certainly not an economist. I mean, certainly the bleeding stops. That's going to be good for everyone. I think it'll clearly, all real estate owners, will take some time for things to get back to normal. So even if COVID ends, it's important if the states need to lift the moratorium and evictions, which is obviously hurting a lot of multifamily owners now if they can't, evict tenants who aren't paying their rents for wrong reasons. So if those restrictions are lifted, that'll certainly help to allow, on the multifamily side, owners to turn units and bring in paying tenants. And then as soon as hotels, it's depending on what happens with travel, obviously hotels and retail, especially in prime tourist areas like Vegas and California and New York, it will take them some time to recover. So I think the hospitality market will unfortunately take a while, even when COVID ends, to recover, just given people's maybe reluctance to travel and stay at hotels.
Yeah.
Hopefully I'm wrong. I wish I'm wrong.
Look, I mean, at least in my point of view, it took the retail world, a good 10 years to recover from the recession, and just as they were getting their legs back under them, and they figured out what shopping centers need to be to compete, with the internet, and also the way that people want to experience shopping centers. This happened, so everything's going to have to get reinvented. Again, there's a lot of smart people and a lot of money out there that will tackle that task, and it will be a monumental task. But it wouldn't surprise me if we're feeling the effects of it one way or the other for more than 5 years.
Yeah, look, and that's why I'm recommending everyone really take a close look and close with the clients at, even if your property's performing well, have a look in the next 12, 24 months and just be ready and be prepared and get with the lender early rather than later.
If you had to advise people in the future about the loan to value ratio that they should be considering when they're looking for loans in the future, has this colored that at all?
Well, I think the last 10 years have already colored it. So I think one of the big lessons learned from the last recession is people, the CMBS market was giving loans up to 80%. That's not happening now. So in some ways, some of the distress we're seeing is much less now than it was in 2008, where people had 80% loans. CMBS loans recalibrated, and most lenders recalibrated after the last recession and reduced leverage to 60, 65%. So I think that certainly helped. I think whether lenders will now reduce leverage going forward, it's certainly happening now. So Fannie and Freddie, for example, the amount of leverage is more 60% rather than 63 or 65% LTV. We're seeing that. But look, ultimately real estate, for those who are investing in real estate for returns, if you've got to have the numbers work, debt is a critical part. So if you can only buy a high-priced asset and you need to maximize your leverage, then you have to do what makes the most business sense for you.
Have you gotten involved at all in workouts on construction loans, or do you just really get involved in performing or now non-performing assets?
No, I've done less now, but yes, there's certainly some construction loans that are being worked out. Slightly different issues. Those obviously won't be, the same CMBS group. They'll often be either banks or private lenders. They won't be with the agencies. They won't be CMBS. So that's where relationships are even more important.
And how have those discussions been going? What's the scenario that you've seen with some of those?
And lenders are, I hate to say this, it is very much case by case. So it depends on where you are in the construction. Obviously, if you're in the middle of construction, lenders don't want to take back a partially constructed building. And so they can be much more amenable to working out the loan with you. Conversely, if your building is almost finished and you have a few months for bucket list items and more relief, it will be harder for the lender to give relief since the property's finished and they can sell it much more easily.
And gosh, I just looked at my watch and I see that it's after 4 now. So I think one last question from Daniel, and that was, how much does the special servicer usually charge? What kind of fee does the special servicer charge?
Yeah, so if it's again, the two types of consents is a performing loan consent, and there's the full special servicing workout consent. So if you're going to the special service to get a performing loan consent, generally, don't quote me, it's between $10,000 to $20,000 plus legal fees of $5,000 and above, depending on level of legal negotiations. For special services, generally, there's no sticker rate. The pooling agreement, which is the underlying document that regulates what the special servicer can and can't do, generally has the fees in it. So if it's generally, they would charge, say, 25 bips per day. It'll be allocated per day for the time for the special servicer to entertain the workout. And then there'll be a separate workout fee that could be anywhere from 25 bips to 1% on principal, but that's all negotiable. But certainly the fees can be quite heavy and it can be quite extensive. So always think twice before you go to a special servicer.
Got it. All right. Well, thank you so much, Aron, for your time and sharing your expertise with us. And for those of you who are joined us today, thank you as well. I will also want to make sure I thank Julia for her help in organizing today's webinar. And this was wonderful. And I think, maybe in another 6 months or so, we ought to check in with you again and get an update on where the world is that you're living in, and you know, how things have changed over the time. I think that would be really interesting. So thank you.
Thank you, David. Thank you, Julian. Most importantly, I hope everyone stays healthy.
That's for sure. All right.
Thank you, Alan. Thank you.
Bye-bye, everybody.